Premature investing without having these three major pillars in place is financial suicide. That's the reality of it. This is part 2 in a video series discussing the 3 major pillars that you need to have in place before you start your investing journey. So I recommend, in full context, that you go check out the first version of this video because it'll give you a lot more context into where we are now in this conversation in the video. But this is essential for you because when it comes to economic resilience and long-term sustainability of your investments, which is literally kind of the golden ticket to our financial freedom towards the end, 9 out of 10 times you're gonna have to invest to get over the hump financially and really be in a good place at some point in your life where you can be financially independent. So in order to do that effectively, these 3 major pillars that I've covered in the first video, I'm gonna cover with you really quickly again in this one, is going to be having strong, stable income, great banking relationships, and great personal credit. For those of you who are brand new, I'm gonna give you a quick introduction on who I am. I am a career financial services, career retail banker, 13 plus years at the time of this recording in the banking industry, the financial services industry. I have an active mortgage license, active life insurance license, FINRA Series 6 investment license, small business banking and credit certified. I literally do private client, small business, and consumer banking all in one. So I do it all for the most part. I cover the broad range of everything I'm going to be talking about. I have my hands in that pot on a daily basis, actively, as well as doing the same thing in my personal and small business finances myself. So I'm coming from both arenas. So the 3 major pillars that I've already laid out for you, why they are so essential for you to have a successful investing career. Covered a lot of the first foundational basis to it in the first video. Go back and check that out. What we're gonna pick up on those 3 going forward is gonna be a major predicator to having success with your investments, and that's gonna be cost of capital. Having a strong, stable income, having great banking relationships, and having a great credit score is gonna have a significant effect on your cost of capital. What is cost of capital for those of you who may not be as familiar? Cost of capital is going to be when you are borrowing money to invest, and that might be real estate is a prominent one, buying other businesses, starting your own business. To a degree, you can make an argument that that's a bit of an investment. Regardless of the scenario, when you are borrowing money to invest, that is your cost of capital. That is one variation of your cost of capital. And what that basically means is whatever interest rate you have to pay on that money is going to basically, be that important to what you need to earn on that investment for it to make financial sense. So an example of that might be I borrow, money to buy an investment property or rental property at 10%. Well, now you need that investment property, that rental property, to basically earn you more than 10% in order for it to make sense. There's a little bit more nuance to it. There's more numbers to it, but that's the general idea of cost of capital for those of you who are new to it. When it comes to having a strong, stable income, great banking relationships, and great personal credit, they all play their own individual role in making sure your cost of capital is low as possible. The number one is going to be strong, stable income. Then you can potentially use your own money to invest effectively. Now, I'll be honest, there's a lot of blurry lines around what that looks like in today's financial landscape. So unfortunately, there's this concept of buying stocks for $5 a piece and stuff like that. Listen, I'm not trying to step on anybody's toes about where they are financially. And yes, to some degree, getting started early with whatever you have can make a big difference. But at the end of the day, I can promise you $5 in a stock is not going to move the needle if you don't pick that pace up somewhere along that investing journey soon enough. You're going to have to throw real money to get real investments. It's the same thing with the rental property game. So when you are dealing with strong, stable income, the second major component that I'm covering in this video is going to be you can potentially be using a good bit of your own capital to invest. Depends on what you're investing in and if it makes sense to do so. But at the end of the day, let's just stick to the stock market situation. A lot of times you're going to use your own capital to do that. You're not likely going to borrow money to go into the stock market on an average case basis. So when you talk about a strong, stable income, that's going to be one of the predicating factors to you being able to just invest your own cash in the first place. You have to have that. And even if you're in the real estate side of the equation, you need to be able to put down money a lot of times. Getting away from the concept of raising money and raising capital. The vast majority of us are everyday people. We're not about to go around to a bunch of family members and people in our neighborhoods and community and ask them to invest in real estate deals with us. We can have that conversation, but I'm just being honest. I'm on the ground. I'm helping clients every day. People aren't just going to do that. And so that means you're going to probably take your own capital, and you need to have a strong, stable income to go do that particular investment strategy and similar investment strategies. The next bucket is going to be your banking relationships. I kind of gave a context to this in the first video as well, but basically on this segment of the video, the deeper the banking relationships are, the better the cost of capital works in your favor. Part of your ability to borrow capital and at what rate you borrow capital is all predicated on risk. Your cost of capital is literally whoever the lender is determining how risky they see you. The closer your relationship is with them, the more financial behaviors they're able to gauge and measure you by, the less risky you are. So believe it or not, relationship banking is a direct component to the cost of capital. It's very important, and that's one of the reasons why it's one of my bread and butter topics on this channel. You will hear me talk about it the first 400 and something videos I film and the next 400 plus that'll be coming out. Trust me when I tell you, relationship banker will stay at the core of my conversation because it is becoming more and more prevalent in you being engaged as a borrower, as a partner to invest in from that bank or that lender. So relationship banking is essential to your cost of capital because it makes you lower risk if you're using it right. The next component is going to be perfect personal credit. Perfect, I'm thinking 760 and above. You're going to get the best auto, mortgage, and any other rates, insurance rates, etc. Anything your credit is pulled up at about a 760 FICO median score. Ideally, all of your FICO scores are 760 and above. You're going to get the best lending rates from the credit perspective in that aspect. You need to have that. Why is that important? Cost of capital. If you have the first two in place, let's just say you have a strong, stable income and you have great banking relationships, but your credit score is a 680. It's okay. You'll get approved for different things. Credit cards, lines of credit, mortgage loans, etc. You'll get approved, but you're gonna pay significantly higher than somebody who has a 780 FICO score. That matters because as I've explained on this channel before, this is the beauty of me working in the industry as a banker. I do this exact formula with every day. So I'm helping the business owners. I have a real estate investor I've been working with who I had to really graduate our relationship and earn his business and his trust because a lot of people who come from that real estate background, the bank is the arch enemy. And I've had to teach him like, look, you keep running to private money, you keep running to hard money, and they're fast, they're efficient, reduce paperwork, more flexible. I get it. It allows you to take down your investments and keep it moving and really scale out and build your business. But what you're not accounting for is the fact that you plan on doing this and you're buying and rehabbing and holding properties for decades at a time. Your cost of capital is going to chew through your investments. So if that, that rental property that you have that private money on, that you're going to pay 2, 3, 4% more than you would get that same long-term financing at the bank in most cases. Now there's some private lenders and some, mortgage brokers, etc., that have access to capital that's a bit on par. But a lot of times you're going to be paying a little bit of a premium for that type of financing. And 2, 3, 4% on a rental property held for 20 or 30 years is a lot of money. You need to have stable income. And if that means you have to get a job or keep a job even that you don't like, bite down and do what you got to do until you can get to a better position. The next thing is your banking relationships. Make sure that you have those budgets, those buckets in place with your banking relationships. Every single dollar is accounted for to the best of your ability. It's optimized so you're saving what you need to save, using credit cards to arbitrage the cost, of goods and services, meaning that you're getting your cash back and your rewards points. So you're getting 2, 3, 4, 5% back on all your spending, and then you're building banking relationships. You're gonna go to these same financial institutions for that real estate loan or any other capital that you try to borrow for various investment strategies as you diversify. Your banking relationship is gonna be a major predicate in saying, okay, you know what? The credit's the same, the income is the same. This person banks with us, this person doesn't. You're gonna come out, even if it's just 0.25%, you're lower risk than someone else. And then of course, having a pristine credit score, your insurance costs, borrowing costs, all of these different things, the credit cards you can get access to arbitrage those points on your different expenses. It's just a whole world around the cost of capital. As you start talking about investing for the long haul, depending on where you are in your journey, make sure you have these 3 pillars in place because your cost of capital will make a huge difference in your returns. So hopefully that hit a light bulb for some of you watching this video. These things are essential. Do not take a stable, strong income for granted. If you have to work a regular job, please don't get caught in the hype of the solopreneur, the business owner, in the perspective that it blinds you from valuing just a good, stable job income. If you can't go out there and be an entrepreneur or a small business owner that can consistently drive revenue predictably, then you need a W-2 job. You need it ASAP. It's the most stable form of income. And again, going back to cost of capital, lenders are most confident with W-2s when they're doing their underwriting. They love W-2s because it's one of the most stable forms of income you can have in this economy. Comment down below and let me know what your investing journey looks like. How's your cost of capital? Are you getting the very best rates and terms? Are your banking relationships strong? Are you using credit cards to arbitrage some of the expenses that you have on your business or your investments or your personal life? All of this adds back into the bucket of you circulating that money and adding to your investments and staying in them long term at the best rates and the best terms. Comment everything that you can think of around this down below. To all my pioneers, like I said, welcome in. If you're new to the channel, I want you to like, comment, subscribe, share the video, support the channel so the channel can keep supporting you. I want each of you to stay focused, stay in motion. I'll see y'all soon.